People lost their homes and life savings. Millions lost their jobs. People committed suicide. And trillions of dollars were wiped out from the economy. It was easily one of the most severe economic crises in history. And not too long before, the financial markets were thriving. The economy boomed and global trades were growing. It seemed like a time of great prosperity. But then in 2008, it all came crashing down.
Bear Stearns was in a death spiral, and the Fed brokered its sale.
The worst financial crisis in modern times. Certainly the largest financial disaster in decades in this country, and perhaps the end of an era in American business.
The year 2008 marks an important time in our history, regardless of whether we were directly impacted or not. It revealed the dark side of the financial world. It showed how greedy, wealthy, and powerful individuals can cause a global economic meltdown, leaving the poor to bear the cost while the rich remain relatively unharmed. This is the true story of the crash. Up until the late 1980s, banking was not the sector that anyone would approach to make large sums of money. It was just plain old banking. You would invest in a safe bond and make a few percent profit many years later. Boring. That was until this guy showed up. He is Luis Ranieri, a former bond trader. He revolutionized the banking sector with just one simple idea.
The mortgage-backed security, or private label MBS.
Soon after that, the money came raining down. This small idea was so profitable to the banks that they made tons of profit over it. But Luis had no clue that his revolutionary idea, combined with greed and excessive risk taking by the banks, would make up the perfect recipe for a worldwide economic disaster. Let's start with the basics. When a person wants to buy a house or property, he generally approaches a bank for assistance if he does not have sufficient money to make that purchase. The bank provides him the required sum, and at that point, the bank, the buyer, and that particular property, all three are tied together by a contract called a mortgage. It basically states the bank has provided a specific amount of money to him to purchase a particular property, and he will repay that amount along with the interest in regular installments over the next 20 to 30 years. If in case he defaults on his loan, the bank reserves the right to seize the property and sell it in order to recover their money. It's just a simple housing loan. But before lending him money, the bank has to do a background check on the buyer to verify his income status. They have to make sure that he has a stable job so that he does not default on his loan. Now, in reality, there are thousands of people that approach the bank to finance their goals of home ownership, each making a contract and hence a new mortgage. Banks bundle up these thousands of mortgages and dissolve them to make a new financial instrument called a mortgage-backed security, or the mortgage bond. This mortgage bond still holds those thousands of individual mortgages, but it functions as a single tradable asset that can be bought and sold on the financial markets. The banks sell these bonds to the investors as an investment option. So now, not only banks could profit from the interest earned over these mortgages, they could increase the profit by selling the mortgage bonds that were made from these mortgages. And that's it. This was the simple idea that Luis Ranieri introduced. Now let's watch how this seemingly simple idea became the monstrosity that collapsed the housing market in America. In the early 2000s, the US government reduced interest rates in banks, making it easier for people to just borrow money and buy a house. This resulted in a huge demand for the houses as thousands of people borrowed money from banks to buy houses. This significantly increased property prices, causing a spike in the real estate and housing markets, because a higher demand means a higher price. To make more profit on this trend, banks created mortgage bonds from these mortgages, which they sold to the investors. Investors were eager to invest in these bonds as the returns on them were astronomical. The returns on these investments were so high that soon the returns from stocks or other commodities seemed inconsequential. This gathered even more attention to the real estate and housing markets. As investors from stock market jumped into the housing market, banks faced an increasing pressure to provide more and more of these mortgage bonds to meet the demand from these investors. But banks could not provide any more because remember, these bonds are made from mortgages, and mortgages are made when people take out loans to buy houses. But after all, there were only so many homes and only so many people with good enough income to buy them, right? But do you know what the crazy thing about profit is? It's never enough. No matter how much profit someone makes, it's never going to be enough. It can even make someone take extreme steps to keep it running. There is a separate word we use for this behavior. When the banks started running out of mortgages to put into mortgage bonds, they started filling them with subprime loans. A loan is called a subprime when it is given to someone who does not have a good credit history or a reliable income. Banks did that because it was in their best interest, as they were charging a hefty margin from the investors to these bonds. And once sold, who cares if these bonds were filled with good loans or bad loans? And thus, banks started approaching people that had little to no guarantee of repaying their mortgages and offered them loans. Yes, there was even a time when banks were approaching people to give them loans. They even incentivized their employees by giving huge bonuses when they register new loans. They gave loans to immigrants, low-wage workers, people with no homes, basically anyone that wanted a new house, they financed him. For people that could not afford a normalized interest rate, they gave them adjustable rate loans. These kind of loans have a varying interest rate, starting with a very low rate of interest and gradually increasing to very high values year by year. And these poor people had no idea what they were signing into. They would sign anywhere as long as they were being promised of getting a house.
These people just want homes, and they go with the flow.
Good for you.
Your companies don't verify.
This portion of people contributed to the majority of mortgages, and banks kept their profit-making machine running as they sold the mortgage bonds to the investors. In 2006, 1/3 of all mortgages were subprime or no documentation loans. A continued demand of houses was increasing the price of properties, but this time, the foundation of this growth was weak. Because this time, the increase in house prices was majorly due to addition of subprime adjustable loans. This situation created what we call a bubble in the housing market, and these subprime adjustable loans were a ticking time bomb. A few years passed, and banks were living in the dream world. They were making money more than they ever imagined. But their honeymoon period lasted only so long as the bomb went off. In 2006, the interest rate on those subprime adjustable loans began to increase, which caused a great difficulty for those with limited income and poor financials. Many found it increasingly hard to pay their monthly EMIs on time. As interest rates kept on rising, the number of loan defaults increased, and as per the mortgage contract, banks seized their properties and sold them to cover their losses. The widespread defaults quickly led to a significant downturn in the US housing market. As the demand for new houses declined and mortgage defaulters increased, the price of houses in the US housing market decreased for the first time, and this was only the beginning. As interest rates continued to climb, the number of loan defaulters escalated, forcing banks to sell off their properties in order to recover their money. This sudden increase in the number of unoccupied homes and lack of new buyers to buy them created a massive oversupply of houses, causing prices to break down. As house prices began to fall, Many properties were now valued at less than the mortgages owed on them. And logically, why would someone pay a high mortgage on a house that had lost its value? So the people willfully defaulted on their loans, creating a destructive cycle of defaulting on loans and drop in price of properties that further added fuel to this wildfire. Not only that, as people were defaulting on their mortgages, the mortgage bonds also started to fail because they are mortgage-backed securities. Their values are derived by the mortgages they consist of. This caused massive losses to the investors who had invested in these bonds. Billions of dollars of investors' money were lost, causing widespread panic and further destabilizing the economy. It doesn't stop here. As investors saw the value of their investments disappear, they lost confidence in the very stability of the US economy and began withdrawing their money from the stock market. This crashed the stock prices of companies, resulting in another severe blow to the US economy. On 27th February 2007, stock prices in China and the US fell by most since 2003. I told you that the subprime adjustables were a ticking time bomb. Up to this point, the fear and panic had become so intense that people had completely lost faith in the banking system and they began withdrawing their savings from their bank accounts. And when this happens, when millions and millions of people start withdrawing their money from the banks, things don't look good. We call this a bank run. A credit default swap was another tradable financial instrument that was created by these big banks and insurance companies for their profit. A CDS is basically an insurance against the mortgage bond that protects the investors if the underlying bond fails. So, before the onset of the crisis, these big banks and insurance companies reluctantly sold the CDS to those who had invested in these mortgage bonds as an insurance against their failure. One thing about the CDS is that it is a derivatives product, which means the people that have not invested in the mortgage bond, they can also buy the CDS. Investment banks and insurance companies sold CDS worth billions of dollars. And though they knew they would have to pay out their customers if the mortgage bonds failed, they thought, what are the chances of that happening? Those bonds will only fail when millions and millions of people default on their loans. And who doesn't pay their EMIs? This was literally the term that these big institutions were resorting to while justifying their excessive risk-taking. In 2007, when the US economy took a downturn, nobody paid their EMIs. The United States stands out as one of the most significant players in the global economy, with one of the largest markets worldwide. Its vast e-commerce platform, extensive trade networks, and abundant resources make it a central hub for a broad range of economic activities. So consequently, any disruption of the US economy can deeply impact the rest of the world. And that's exactly what happened in 2008. The cash reserves in most of the banks around the world had depleted to dangerously low levels. Not only were the people unable to withdraw their savings, it also induced a credit crunch in the economies worldwide. This shortage of credit was particularly harmful, as most businesses rely on fundings by external sources, such as banks and investors, to function properly. The scarcity of funds brought major businesses to a halt, and small businesses almost died down. This slowed down the economical growth in most countries and caused unemployment at a massive scale. There were even the events of economic collapse of entire countries. Iceland had 3 major banks and all of them failed due to bank runs, causing the economic collapse of Iceland. Relative to the size of its economy, Icelandic collapse was the largest economic collapse suffered by any country in history. This is just one of many examples that shows the severity of the 2008 financial crisis. Lehman Brothers was the 4th largest investment bank in the United States and maintained its offices all around the world. It had one of the highest exposure to the subprime mortgages. On September 15, 2008, after being operations for 158 years, Lehman Brothers filed for bankruptcy. More than 26,000 of its employees were laid off. Bear Stearns, another big investment bank. Just like Lehman Brothers, it too suffered a terrible loss. But instead of filing for bankruptcy, Bear Stearns was bought by JP Morgan Chase for a mere price of $10 per share. When just 1 year before that, Bear Stearns' share price was at an all-time high of $172. Again, these are just a few examples out of many that shows the extent of damage on the global economy. The impact of this crisis was so strong that it started a global economic recession that lasted more than 3 years. So many people lost their jobs that in 2009, unemployment rate was over 10%. After listening to this story, you would not be wrong to think that the government must have taken steps for the betterment of life and punished the ones responsible for this economical disaster. In fact, the majority of people would think that the government agencies would do justice to them in hard times like these. But the reality is somewhat different. You might use of the people, by the people, and for the people while defining a government, but the government's priority is not the people. Government keeps the economy above all. And the government did what it always does when the economy falls.
There's going to be a bailout.
It deployed massive bailouts of financial institutions to protect the global financial system. In October 2008, the US government signed into law the Troubled Asset Relief Program that provided $700 billion in bailout funds for financial institutions. A bailout happens when a big company has suffered a terrible loss and the government gives money to that company to mitigate their losses so that it keeps on functioning. Government does that because the size and influence of that company on economy is so strong, its failure can be catastrophic to the economy. They are labeled as too big to fail. Here is the list of all the companies that were bailed out by the US government in 2008. The entire sum of $700 billion of the Troubled Asset Relief Program was used to bail out these companies. But it was only enough to prevent the total collapse of United States economy. As this crisis had induced the Great Recession, in February 2009, President Barack Obama signed another package, the American Recovery and Reinvestment Act, that was valued at $831 billion. Its main objective was to restart the economic growth, to protect the existing jobs, and to create new ones as soon as possible. Those two packages, the Troubled Asset Relief Program and the American Recovery and Reinvestment Act, valued over $1.5 trillion combined. $1.5 trillion. If you remember the PM CARES fund that was inducted in 2020 by the Indian government to help the general public in COVID-19 pandemic, as of 31 March 2022, the total size of this fund was above Rs 20,000 crores, which was highly appreciated for its big size. If you think this was big, then this is what $1.5 trillion looks like. This is $1.5 trillion of the taxpayers' money. $1.5 trillion of common people like you and I, but just American. Think about it for a moment and you will get the idea of just how big this number is. My goal here is not to criticize the US government for this massive spending, as this expense was extremely important. Because if this was not done, the entire global financial system would have collapsed, and the outcomes of that would have been even more devastating. All the countries and their economies would be set back by decades. My goal here is to highlight just how broken our financial system is. The banks, credit rating companies, insurance companies, the investment banks, and many other financial institutions took huge risks to fill their pockets, and when the economy crashed, the general public had to pay $1.5 trillion to heal the wounds. The ones that were already rich walked away with little to no effect on them. while the poor were plunged into more poverty. When the dust settled from the collapse, $5 trillion worth in pension money, real estate value, savings, bonds, and stocks had completely disappeared from the US economy. 8 million people lost their jobs, 6 million people lost their homes, and this was just in USA. The global numbers were even greater. Was everyone so careless? Did nobody see this crash coming? Well, there were a few that saw the giant lie at the heart of the economy, and they decided to act upon it before anyone else did. This is Michael J. Burry, a fund manager in a small company. He looked at individual mortgages that were in those mortgage bonds and knew that once the interest rates go up, those mortgage bonds will fail. He was the first person ever to buy the credit default swaps and made billions of dollars in profit when the rest of the economy was crashing. There is a movie, The Big Short, which is based on his story. There were few others like him that saw the whole truth and took precautions to protect themselves from the crash. But there is one more story, my favorite. There was someone who realized that the entire financial system runs on the trust-based model. We all trust these big banks and companies to conduct large-scale financial activities. We trust them and place our finances in their hands. And where there is trust, there is also betrayal. He goes by the name Satoshi Nakamoto. Nobody knows who he is, what he looks like. We don't even know if this is his real name. All we know is, when the economy was crashing in 2008, he gave this world a hope. On October 31, 2008, he published a document that described a revolutionary technology. On January 3, 2009, Satoshi pushed the switch, his creation went live, and the world would never be the same.